stock chart technical analysis with the bearish engulfing candlestick pattern, which is most ideal if the second candle engulfs the entire high to low range of the first candle, instead of just engulfing the first candle's real body range, which is acceptable but slightly less bearish, especially when the low of the first candle is not engulfed by the real body of the second candle. Though that isn't the case on this chart, that has price quickly trade and close under the low of the entire bearish engulfing pattern to quickly advance the current downtrend, where there are several examples of bearish engulfing candlestick patterns for short-term downswings, more in the context of bearish continuations rather than the more common association with full trend reversals like at the beginning of this example. When looking at candlestick charts and using Fibonacci retracements, close formation right on the Fibonacci levels is often more common with candlestick patterns comprising of fewer candles, especially single candlestick patterns such as the bull hammer, and generally within narrower ranges for larger patterns such as the three methods rising pattern. On the other hand, when a candle pattern has a wide range, the chart will usually be experiencing higher volatility, especially for short durations like on this chart. So candle patterns may come close but won't exactly touch the exact Fibonacci levels. However, stronger confirmation of the bearish intent will still be price trading and eventually closing under the low of the bearish engulfing pattern. With this particular case, the first candle also adds elements of the bearish star and gravestone doji candlestick patterns, which demonstrates why it's more important for at least the low price of the first candle to be engulfed by the second candle's real body, and why it's less important for the high of the first candle to be engulfed by the real body range of the second candle. And in this case, the bearish engulfing pattern reversed a minor to moderate upswing, but in the bigger picture, it was a key point for the larger bearish continuation. Sometimes bearish reversal patterns before a major event can hint at a large drop in the near future that will usually take the form of a gap down. This is an interesting observation, but generally not useful or practical, because it's not consistently reliable, especially for events such as earnings reports, and the large movements that can usually result from them. It's quite possible for a bearish engulfing or other bearish reversal pattern to form prior to a major news announcement that even has confirmation with a close under the pattern's low, but the end result a few days later can see little to no movement or even a gap up. So the takeaway here is to not rely on candlestick patterns prior to major news announcements. Now we define the gap down range close to the real body range of the gap down candle, where resistance takes the form of a bearish engulfing pattern, which will be used to reference future resistance in conjunction with the gap down range we marked earlier. Volatility increases and price even briefly goes over 1030, but it does not close over 1030 and, more importantly, doesn't move over the short-term reference, which would be the high of the bearish engulfing pattern. Support is quickly encountered nearing the range of the previous upswing point. Then, when returning back up to the resistance area, there's a good example where the bearish engulfing pattern isn't followed by a quick downward reversal, because price only briefly trades below its low, and there's not even a close below the bearish engulfing's lowest price. Instead, price remains around 1030 and even goes above the high of the bearish engulfing pattern. The incline is further sustained by increased green volume, but in the broader context, this entire range is never surpassed, and instead it remains a useful reference for resistance, but now it becomes a reference for this current gap down's fill range, which is recontacted soon enough, resulting in a successful breakout this time. The next chart begins with a similar situation. Price rebounds to a clear recent resistance area, which now expectedly pushes the chart back down. The candles make the short-term context very bearish, with the bearish shooting star being bearishly engulfed. However, the result is only a small drop before quickly rebounding. And actually, this isn't too uncommon. Now, the main thing to watch for is a decisive close over the bearish engulfing's high, which in this case is also the bearish shooting star's high since it has the highest price of the two candles. In this case, there's only a brief period of trading above previous highs before sharply dropping. So in this case, the bearishly engulfed bearish shooting star marked the beginning of a more gradual transition to bearish sentiment rather than just a quick, sharp reversal that immediately accelerates after closing below the bearish engulfing's low. Naturally, price returning to this area meets resistance, but in addition to an absence of lots of red candles and increasing selling volume, the few bearish candles that do appear have little to no bearish confirmation, and instead price steadily goes over their highs and the highs of the previous resistance range to demonstrate the possibility of fading influence from candlestick and even chart patterns over time. Illustrating these points further, when price does drop back below this area, there's a minor pause but nothing significant.